Hello, I'm Brian Beaulieu, CEO, Chief Economist of ITR Economics, and thank you for joining me for this edition of FedWatch. This is Friday, April 14th, 2023. And Wednesday of this week, the FOMC meeting minutes came out, the two-day meetings that they had in March. And there was an interesting little tidbit in there. The Fed economists are now forecasting, because of the banking situation, that they say that a recession is probable by the end of 2023. That's a sea change from the soft landing that they had been propagating up until that time. I still don't think it's because it's so much of a systemic banking failure is at issue. It's the credit drying up that is at issue. Banks are becoming much more reluctant, much tighter in terms of their credit conditions, and that just means liquidity is less available. And that's going to be another bullet point. The first bullet point I want to talk about, though, is the Fed shifting to a recession outlook. That'll be interesting to see if they still go ahead and push up rates one more time, even though they acknowledge that they're causing this recession. It would be like them to still go ahead with one more rate increase anyways. It's just they don't have to, is our longstanding opinion. There's another bullet point I want to talk about, and that's the New York Fed came out with their annual report on the System Open Market Account, as it's called. And they're saying that they expect that the Fed balance sheet is going to be skinnied down. They're going to, they've already started bringing it down, and that they expect they're going to be bringing it down until the middle of 2025. Why that matters is because if they are shedding assets, bringing down the balance sheet for that long, it could delay the onset of the 2025 recovery. It really caught my attention that if they are thinking about mid-2025 before they start increasing the balance sheet again, and they think that they will from sometime in 2025 or reverses direction, and they say likely increasing gradually all the way to 2030, which also caught my attention, obviously. But if the Fed is going to remain, let's say, not accommodating through 2025, it will make it more difficult to get that recession started. Of course, the Fed can change their minds. They have in the past. It's just right now that's one of the road signs that we look at, and it seems to be pointing toward more of a difficult road for recovery in 2025. And the third thing I wanted to mention was I've become aware of this wall of debt that needs to be refinanced in the commercial real estate market over the course of 2023 and 2024. 70% of that commercial real estate debt is held by banks, mostly small banks and regional banks, not the big boys. And they're the ones that are really tightening up their standards. They're the ones that are really going to be looking at whether the cash flow on this real estate property still works, et cetera. We've already seen where some REITs have taken a beating. For instance, the S&P United States REIT Real Estate Investment Trust, which is a very broad look at REITs, is down 26% since December 31st, 2021. So it's taken a beating. The S&P 500 Real Estate Index is down 54.1% since the end of 2021. And the Green Street Commercial Property Price Index is down 15% since prices peaked about a year ago. So we're seeing weakening prices. We're seeing REITs taking a beating. And, there's two things going on here. There's that threat about when these refinancings need to happen, if the money's going to be there, whether the Feds can come in and save the day, or whether the large banks are going to come in, what sort of accommodations are going to be made. But that's a very real risk for the commercial real estate market. And it's consistent with what we had been saying when people ask us, should we be buying commercial real estate? We haven't been very keen on commercial real estate this cycle. And I would still be very, very reluctant to make a new investment in that arena, which leads to the second point. And that is, this will turn around. It will reverse. And what that means, I think, as an investor, is start looking for some really good prices over the course of 23, 24. Make sure, though, that the demographics and the economic diversity are solid in that area. And you should be able to get a pretty good price in more favorable terms than you can get today. So I see it as a future opportunity rather than a near-term threat. You can look at it either way, either the glass is half full or it's half empty. So the Fed's calling for a recession. That's new. The New York Fed sees tight conditions continuing on through most of 2025. That's not good for our recovery. And commercial real estate prices are coming under appreciable downside pressure, and REITs are as well. Keep an eye on that. We're going to be working up some additional analysis on those pricing trends, and I'll report on that down the road. Thank you for joining me for this edition of FedWatch.